I'm delighted to welcome you to our discussion on M&A in upstream oil and gas, with a focus on the current environment, impact of price movements, and what appears to be more confidence in the deals market. So Adrian, what do we see happening in the deals market?
So we've had quite a few lean years, but towards the end of 2016, we suddenly had a wave of M&A activity, and there were a lot of deals that were made, and these were asset deals. What triggered those deals was a sense in the market that we'd reached a floor price of around about $50 a barrel, and therefore buyers and sellers could agree how to value assets. So you saw a lot of the big and the small players divesting non-core assets, and similarly you saw players acquiring assets that complemented their portfolio. The other interesting thing there was also that you didn't have a wave of major corporate transformational deals, so big companies buying other big companies. You had Shell, for example, buying BG in 2015, but typically these tend to be quite costly, risky deals to execute, so you didn't see that. So lots of asset deals, definitely that's been the flavour of the month.
Okay. And Neil, Adrian has talked about disposal of non-core assets, and of course we've seen an uptick in North Sea, continental shelf asset disposals. What do we see as driving that activity?
Well, I think a major part of that is the interest of private equity in the sector and new money that's coming in. We've seen deals by Cryosor, by Neptune, and also by players such as Ineos. And I think what they're seeing is actually a mature basin, but one which still has value in it and brings a lot of the qualities that maturity brings. So good management teams, good business models, and actually, being run with a slightly different focus, the ability to drive out incremental value there. I think the other thing I'd add is we're seeing some of the stumbling blocks being dealt with. So firstly, decommissioning has been a challenge in the past. I think buyers and sellers now are finding creative ways to deal with that. And also people are increasingly using contingent price mechanisms to allow that future uncertainty to be built into a deal value in a way that actually reduces the risks that parties are taking on.
And how do we see the market evolving going forward?
Well, certainly if I was confident that we were still around at about a $50 price value, you would sense that maybe that momentum would continue. I think the caveats are the following. First of all, the price has dipped below $50 now. And I think the second thing is if you look at the volume of deal values, Q2 versus Q1 this year, it's already down by about nearly 60%. So clearly the momentum is beginning to slow down a little bit. But I think the key thing to remember is that for a lot of our clients, they need to look at M&A through a strategic lens. So what are their long-term growth aspirations? What are the capabilities they want to build? And how does their portfolio complement that? So I think there's still opportunities for M&A, clearly, but they need to be seen through a strategic lens.
And I'd just add the fact that the industry has dealt fantastically well with a couple of years of challenging price environments. I think it is well positioned for a very good future, and I think M&A will play an active part in that.
Great. Well, thank you, Adrian. Thank you, Neil. Clearly, lots of opportunity. It's important that people think carefully about their M&A objectives and how to execute these. As a firm, we've been involved in most of the major recent deals, and we look forward to supporting our clients as they navigate what is an evolving market. So if you have any questions, please feel free to contact me and the team.